The hidden war over interest rates. It began with a single press release, a quiet statement from a central bank that should have calmed the markets. Instead, it triggered a chain reaction that exposed a silent battle unfolding behind the scenes, a battle that would shape the fate of currencies, economies, and fortunes around the world. This story matters now because interest rates aren't just numbers on a chart. They are the pulse of the global system. Every mortgage, every loan, every investment rises and falls with them. And in an age where inflation spikes, growth slows, and political tensions rise, the decisions made in central bank boardrooms can send shockwaves through billions of lives. To understand how fragile that balance is, we need to revisit the moment when two powerful forces clashed over the future of money itself. It started with inflation creeping higher month after month. Prices rose faster than wages. Consumers felt squeezed. Investors grew nervous. Some economists urged immediate rate hikes. Others warned that tightening policy too quickly could choke off recovery. The central bank stood in the middle, responsible for stability, yet pressured from every direction. Inside its headquarters, disagreement brewed. A faction of policymakers believed inflation would fade on its own. Another faction argued that decisive action was needed before the economy overheated. The debates grew louder, more emotional, more urgent. But on the outside, the public heard only carefully crafted statements, not the tension swirling beneath them. The early reveals surfaced when a leaked memo hinted at divisions within the bank. Markets reacted within seconds. Bond yields jumped. Currency traders repositioned. Analysts speculated about internal conflict. The idea that the guardians of monetary stability were divided sent a tremor through global finance. Soon, hedge funds and institutional players sensed opportunity. They began placing massive bets on what they believed the bank's next move would be. Some wagered on aggressive rate hikes. Others bet on a dovish pivot. Billions flowed into positions designed to profit from even the smallest shift in policy. The war had begun, not with armies or weapons, but with expectations, forecasts, and the power to influence the direction of money. And beneath the calm surface of official statements, the deep struggle was only beginning to show. The tension escalated as economic data refused to cooperate. One month showed easing inflation. The next month reversed it. Growth indicators flickered unpredictably. Every new report became ammunition for one side of the internal debate or the other, and the markets, desperate for clarity, swung violently with each hint of direction. The reveals sharpened when a senior policymaker made an unusual public comment. Subtle, almost cautious, yet unmistakably hawkish. Within minutes, bond markets convulsed. Yields spiked. Traders interpreted the remark as a signal that rate hikes were imminent. Currency desks repositioned at lightning speed. Even equity markets, typically slower to react, dipped sharply. A single sentence had unleashed a ripple powerful enough to reshape expectations globally. Inside the central bank, frustration simmered. Every external comment, every leaked detail, every shift in tone fueled speculation the policymakers could no longer control. Meetings stretched longer, filled with charts, projections, disagreements, and warnings about credibility. The institution built on trust now faced the risk of sending mixed signals to a world that depended on its clarity. Meanwhile, hedge funds intensified their positions. Some sought to corner the narrative, timing bets around press conferences and policy announcements. Others dug into supply chain data, real-time price trackers, and satellite imagery to gain an edge. Billions of dollars moved in anticipation of what the next rate decision might be. For these players, it wasn't just policy, it was war through volatility. The early conflict formed when an unexpected shock hit the system. A geopolitical flare-up sent energy prices surging, reigniting inflation fears overnight. Traders immediately shifted into defensive mode. The hawkish faction inside the central bank felt vindicated. The dovish faction urged caution, warning that tightening policy during a fragile moment could trigger recession. Pressure mounted on the institution from all sides. Politicians demanded lower rates to support households. Business leaders pleaded for stability. Global allies watched closely, knowing that one country's decision could ricochet through their own economies. The weight of expectation grew heavier each day. And then came the moment that shook the markets. A second leak, this time suggesting the bank was preparing not just one rate hike, but a series of them. Analysts scrambled to rewrite forecasts. Traders pounced. Volatility spiked across every asset class tied to interest rates. The hidden war was no longer invisible. It was unfolding in real time, inside boardrooms, across trading floors, and through the invisible threads tying global markets together. The stage was set for the next move, one that would either restore confidence or fracture it even further. The break came on the morning of the policy announcement, and event traders were already calling the most important decision in a decade. Hours before the statement, markets thrashed wildly. Bond yields swung in violent arcs. Currencies whipsawed. Futures contracts flipped and reversed with every rumor. It felt as if the entire financial system was vibrating, waiting for a single sentence that could tilt global money flows in one direction or the other. Inside the central bank, the atmosphere was electric. Policymakers sat around the long table, faces drawn, arguments exhausted. Some urged a bold move, a sharp rate hike, to crush inflation decisively. Others warned that the economy was too fragile, that such aggression could trigger mass layoffs and tip the nation into contraction. Both sides believed they were protecting the public. Both feared they were one decision away from catastrophe. The conflict peaked when a last-minute data revision landed on the table. The numbers showed inflation cooling faster than expected. For the dovish camp, it was proof that patience was working. For the hawkish camp, it looked like a temporary dip masking deeper structural pressures. Voices rose. Old alliances cracked. The institution built on unity now teetered on division. Meanwhile, on trading desks worldwide, anticipation turned to anxiety. Hedge funds adjusted positions with frantic precision. Banks hedged exposures they normally considered safe. Retail traders watched price feeds that jumped with every whisper, every leak hint, every analyst prediction. The entire marketplace strained under the weight of uncertainty. When the decision finally dropped, the air seemed to split. The bank raised rates, but far less than markets had expected. It was a compromise, a Hail Mary attempt at balancing stability and caution. But compromise is rarely calming. Within seconds, chaos erupted. Bond yields plunged, then rocketed upward in the same minute. Currency markets convulsed as algorithms tried to interpret the tone behind the decision. Stocks soared in relief, then reversed in panic. Analysts contradicted one another live on television. Some called the move courageous. Others labeled it reckless. And then came the second blow. During the press conference, the bank's governor delivered a message that contradicted the policy tone. His words hinted at uncertainty, at the possibility of reversing course if conditions shifted. Markets froze. In that instant, the carefully crafted decision unraveled into ambiguity. Traders who had bet on clarity now saw only fog. Volatility exploded. Some funds made fortunes. Others suffered deep, unexpected losses. The split inside the bank now echoed across every global market, amplified by algorithms, leverage, and fear. Investors no longer debated what the bank would do. They debated whether the bank still knew what it wanted. This was a full conflict, messy, destabilizing, impossible to contain. A war not just over interest rates, but over confidence itself. And as markets spiraled, one thing became clear. The true climax was still to come. The climax arrived in a moment of sharp, unsettling clarity. Just days after the chaotic announcement, new inflation data hit the wires. Higher than expected, hotter than anyone predicted. Markets reacted with instant fury. Bond yields spiked violently. Currencies swung as if caught in a storm. Equity markets buckled under the weight of a single, brutal truth. The compromise had failed. Confidence in the central bank fractured. Analysts accused officials of hesitating at the worst possible moment. Politicians pointed fingers. Traders braced for the next decision, knowing it would have to be stronger, harsher, more definitive. The hidden war was no longer hidden. It had erupted into the open, a battle fought through headlines and charts. In an emergency meeting held behind closed doors, policymakers confronted the reality they had tried to avoid. Their credibility was on the line. Inflation was not easing. Markets were not stabilizing. And their attempt to balance caution with assertiveness had satisfied no one. This time, voices rose not in debate, but an urgency. They needed a decisive move, one that would regain control of the narrative before the damage spread further. When the new policy was announced, a sharp rate hike, far larger than expected, the markets jolted. Shock first, then disbelief, then, slowly, a fragile sense of relief. The clarity that had been missing for months finally returned in a single, forceful decision. Yields adjusted, currencies steadied, equity markets found footing, though still shaken. The resolution settled over the global financial system like a long exhale. The battle over interest rates had left scars, lost wealth, shaken institutions, and a lingering distrust of the very authority meant to protect stability. But it also revealed something deeper. The world economy doesn't just follow numbers. It follows belief, confidence, conviction. When these fracture, chaos follows. Modern relevance echoed loudly. Today's markets move faster, amplify harder, and punish hesitation more brutally than ever before. Central banks hold immense power, but even they are vulnerable to the expectations they help create. One misstep can reshape global money flows. One mixed signal can ignite volatility across continents. As investors reflected on the turmoil, one question lingered. In a world that's interconnected, where every decision sends ripples across the globe, how long can stability last before the next war over interest rates begins? Sometimes the smallest shift in perspective becomes the beginning of a new future.